Dorothy is 73 years old. She lives in Tucson, Arizona. She retired after 34 years as a high school principal. She has a traditional IRA worth just over $420,000. Every single year since she turned 72, the IRS has forced her to take money out of that account whether she needs it or not. They call it a required minimum distribution. In 2024, Dorothy's required distribution was just over $19,000. She took the money. It hit her bank account. She reported it as income on her tax return. She paid federal income tax on every dollar. And then, like she has done for decades, she wrote a $3,000 check to her church's building fund. She got no tax benefit for that donation because she takes the standard deduction and her church gift was not enough to push her over the itemizing threshold. Dorothy does everything right. She saves. She gives. She files her taxes honestly every year with the same preparer she has used for 9 years. And she has been paying taxes she did not have to pay for 3 years running. Not because she did anything wrong, because nobody told her about a specific rule buried in the tax code that was built exactly for someone in her situation. This video is for educational purposes only and is not tax or financial advice. Consult a qualified tax professional before making any decisions about your specific situation. My name is Kevin Retirement Strategy. Every week, I break down the tax rules, the financial traps, and the strategies that protect retirees from the things nobody else is explaining. If that sounds like something you need, hit the subscribe button right now and turn on notifications so you never miss a video. Today I am going to walk you through the single most powerful and most overlooked tax strategy available to retirees who have a traditional IRA and give to charity. I am going to explain exactly how it works, why it is so valuable, what the 2025 limits are, why your tax preparer may have never mentioned it, and what you need to do right now to use it before the end of the year. I am also going to show you the real numbers on what this costs retirees who do not know about it, because the annual amounts look small, but the lifetime cost is significant. And I am going to cover a newer expansion of this strategy that most people, including most financial advisors, have not yet started talking about. Let me start at the beginning because to understand why this rule is so powerful, you have to understand the problem it solves. When you put money into a traditional IRA during your working years, you got a tax deduction. The government let you defer the taxes on that money while it grew. But the IRS was never going to let you keep it tax deferred forever. That is why required minimum distributions exist. Once you turn 73, the IRS requires you to withdraw a specific amount from your traditional IRA every year based on your account balance and your life expectancy. That withdrawal is ordinary income. It gets added to your adjusted gross income on your federal tax return. It gets taxed at your marginal rate. And here is where the problem compounds. That forced income does not just generate a tax bill at your ordinary income rate. It also pushes more of your Social Security benefits into the taxable zone. The federal formula for Social Security taxation uses something called combined income, which is your adjusted gross income plus tax-exempt interest plus 50% of your annual Social Security benefit. When your required minimum distribution lands in your AGI, it raises your combined income. And when your combined income crosses $34,000 for a single filer or $44,000 for a married couple, up to 85% of your Social Security becomes federally taxable. So a single required minimum distribution of $19,000 does not just create a $19,000 taxable income event. It potentially makes thousands of dollars of your Social Security taxable that would have been untaxed without it. And if you live in one of the 8 states that still taxes Social Security, that same distribution can trigger a state tax bill on your Social Security income on top of the federal one. It is a cascade. One forced withdrawal creates tax consequences in multiple places at the same time. This is what Dorothy was dealing with. Every year her preparer reported the full distribution. The tax bill came. She accepted it, and she moved on. She had no idea a single phone call to her IRA custodian could have changed the entire picture. Now let me explain the rule that changes everything. And I want to be precise about how it works because the details matter. The Qualified Charitable Distribution, which the IRS calls a QCD, allows anyone who is 70.5 years old or older and has a traditional IRA to instruct their IRA custodian to transfer money directly from the IRA to a qualifying charitable organization. The money never goes to the account holder first. It goes directly from the IRA to the charity. And because it never lands in the account holder's hands, the IRS does not count it as taxable income. It is excluded from your adjusted gross income entirely. It does not appear on line 4B of your Form 1040. It does not count toward combined income for Social Security taxation. It does not trigger Medicare surcharges. It does not push you into a higher tax bracket. It is as if the distribution never happened, at least for income tax purposes. But here is the part that makes it even more valuable. The Qualified Charitable Distribution counts toward your required minimum distribution for the year. So if your RMD is $15,000 and you direct $5,000 of that to a qualified charity as a QCD, you have satisfied $5,000 of your required distribution. You owe no tax on that $5,000. And you can take the remaining $10,000 as a regular distribution and pay tax only on that portion. If your charitable giving for the year is equal to or greater than your entire RMD, you can satisfy the entire required distribution through QCDs and owe no income tax on any of it. For someone like Dorothy, who is taking $19,000 in required distributions and giving $3,000 to charity, she could have directed that $3,000 as a qualified charitable distribution, excluded it from her taxable income, satisfied $3,000 of her required distribution without touching her bank account, and paid tax only on the remaining $16,000 she actually needed for living expenses. The church gets exactly the same donation. Dorothy keeps more money. The only thing that changes is the mechanism of the transfer. Now let me talk about the limits, because this is where 2025 is different from prior years in a meaningful way. For many years, the qualified charitable distribution was capped at $100,000 per person per year. That limit was in place for roughly 2 decades. Then Congress passed the Secure Act 2.0 in late 2022, and one of the provisions it included was an inflation adjustment to the QCD limit. Starting in 2024, the $100,000 cap began adjusting for inflation each year. For the 2025 tax year, the qualified charitable distribution limit is $108,000 per person. If you are married and both you and your spouse have traditional IRAs, each of you can contribute up to $108,000 in QCDs from your individual accounts, for a combined total of $216,000 in tax-free charitable transfers in a single year. That is not a typo. That is the rule. A married couple with 2 traditional IRAs can direct up to $216,000 in total to qualifying charities in 2025, satisfy up to $216,000 of their combined required minimum distributions, and exclude the entire amount from their taxable income. For a couple in the 22% federal bracket, that is a potential tax savings of more than $47,000 in a single year before you factor in the additional savings from reduced Social Security taxation and potential Medicare premium reductions. The $108,000 limit exists precisely because Congress recognized that high-balance IRA holders who are charitably inclined should not be limited in their ability to redirect forced distributions to causes they care about. Whether your annual charitable giving is $2,000 or $80,000, the qualified charitable distribution is likely the most tax-efficient way to make that gift from your IRA. If this is the first time you are hearing about this, hit the like button right now. This is exactly the kind of information that should have been in your tax planning conversation years ago. Subscribe and turn on the bell so you never miss a video like this one. Now I want to explain why so many tax preparers have never mentioned this to their clients. Because I get asked this question constantly, and the answer matters. The qualified charitable distribution does not show up in a way that makes it obvious on the tax forms that come in the mail. Every year, your IRA custodian sends you a Form 1099-R. This form reports how much money left your IRA account during the year. The problem is that Form 1099-R often does not distinguish between a taxable withdrawal and a tax-free qualified charitable distribution. In many cases, the 1099-R shows the full distribution amount with a code that indicates it was a normal distribution, and the custodian notes somewhere on the form that a portion was a QCD, or sometimes not even that clearly. When your preparer receives this form, they often see a distribution amount. Enter it on line 4A of your Form 1040 as the gross distribution, and then look to see what amount is taxable. If nobody told them a QCD was involved, They may report the entire amount as taxable income and move on. The IRS does not automatically correct this. There is no system that flags the return and says, wait, this person gave money directly to a charity from their IRA. The full amount should not be taxable. The taxpayer or the taxpayer's representative has to know to mention it. The way the exclusion works is specific. The full distribution amount goes on line 4A as the gross distribution. The taxable portion, which excludes the QCD amount, goes on line 4B. The word QCD is written on the dotted line next to 4B to indicate why the taxable amount is lower than the gross. A preparer who does not know about QCDs or who does not think to ask whether any charitable transfers were made directly from the IRA will put the same number on both lines and report the entire distribution as taxable income. This is what happened to Dorothy for 3 years in a row. Her preparer was not dishonest. He was not negligent in a dramatic way. He simply did not ask the right question, and Dorothy did not know she needed to tell him anything different. She thought taking an RMD was taking an RMD. She did not know there was a better way. The result is that millions of retirees who give to charity and have traditional IRAs are overpaying federal income tax every single year, not because the rules do not protect them, because they do not know the rules exist. There is a newer version of this strategy that became available through the Secure Act 2.0 that I want to spend a moment on, because it opens up possibilities that the original QCD rule never allowed. Beginning in 2023, Congress added a one-time provision allowing account holders to make a single QCD of up to $53,000 to a split-interest charitable entity. In 2025, this one-time limit has adjusted to approximately $54,000 after the inflation adjustment. A split-interest charitable entity includes a charitable remainder annuity trust, which pays you a fixed income for the rest of your life and then passes the remainder to the charity, and a charitable gift annuity established through a qualifying nonprofit organization, which works similarly. This expanded provision allows a retiree with a large traditional IRA to do something that was previously impossible. You can take a significant one-time QCD from your IRA, direct it to a charitable gift annuity, receive income payments from that annuity for the rest of your life, exclude the initial transfer from your taxable income, and ultimately benefit the charity when you pass. This is not a strategy for everyone. It requires working with an estate planning attorney and a qualified financial advisor who understands how charitable remainder trusts and gift annuities work. But for a retiree with a large IRA who is charitably inclined and wants to generate a predictable income stream, this is one of the most powerful planning tools now available. Let me show you the real numbers on what not knowing about the qualified charitable distribution costs over retirement. Take a single retiree, 73 years old, traditional IRA balance of $380,000. Her required minimum distribution in 2025 is approximately $14,100 based on the IRS Uniform Lifetime Table. She gives $4,000 per year to her church and a local food bank. She is in the 22% federal tax bracket. Without the QCD, she takes her full $14,100 RMD as a taxable distribution. She reports $4,000 of charitable gifts on her Schedule A. But because she takes the standard deduction, which at her age in 2025 is higher than her itemized total, the charitable donation provides no tax benefit. Her federal tax on the $14,100 distribution is approximately $3,102. With a QCD of $4,000 made directly to her charities from her IRA, she excludes $4,000 from her taxable income. Her taxable distribution is now $10,100 instead of $14,100. Her federal tax on that amount is approximately $2,222. The savings is $880 in that single year. But that $880 is not the full picture. Because her adjusted gross income is lower by $4,000, her combined income for Social Security taxation purposes is also lower. If she receives $22,000 in Social Security benefits, reducing her AGI by $4,000 could reduce the amount of Social Security that is federally taxable. Depending on exactly where she sits relative to the thresholds, that reduction in Social Security taxation could save her another $440 to $660 in taxes on top of the direct income tax savings. So the total annual benefit of the QCD for this particular retiree is not $880. It is likely $1,300 to $1,500 per year when you count the Social Security tax reduction. Multiply that by 20 years of retirement. You are looking at $26,000 to $30,000 in taxes paid unnecessarily by a retiree who gave to charity faithfully every single year and had no idea the IRS had built a mechanism specifically for her situation. That is Dorothy. That is millions of people just like her. Now take a married couple with larger IRA balances. Both are 75 years old. Their combined required minimum distributions are $60,000 per year. They give $18,000 per year to their church, a local hospital foundation, and their grandchildren's scholarship fund at a state university. Neither charity is new. They have been giving to all three for years. Without QCDs, they take $60,000 in taxable distributions. They report their charitable gifts on Schedule A. Because their standard deduction for a married couple where both are over 65 is substantial, and because the new senior bonus deduction adds another $12,000 on top of that for couples where both spouses qualify, they have a high bar for itemizing. Their charitable deductions may or may not exceed the standard deduction threshold, but their $60,000 in distributions is fully taxable either way. With QCDs of $18,000 split between their two IRAs based on their respective giving, they exclude $18,000 from their combined taxable income. Their taxable distributions drop to $42,000. At their tax rate, the direct income tax savings is meaningful, and the reduction in their combined income for Social Security taxation purposes could reduce or eliminate the state and federal tax on a portion of their Social Security benefits. For a couple in this situation, the difference between using QCDs and not using them over a 20-year retirement is readily above $50,000 in total taxes paid unnecessarily. The charity receives the same gifts. The couple keeps tens of thousands of dollars more. The IRS collects what it is owed and nothing beyond that. That is the system working correctly. And the only reason it does not work for millions of retirees is that nobody told them about it. If that number surprised you, hit the like button right now. This is exactly the kind of information that financial planning conversations should include, but almost never do. Subscribe and turn on the bell because next week I am covering another strategy that interacts directly with this one. Now let me talk about the mistakes people make when they try to use the QCD for the first time, because the rules have some specific requirements that trip people up and can disqualify the transfer if you are not careful. The first mistake is taking the distribution first and then giving it to charity. This disqualifies the QCD. The money must go directly from the IRA custodian to the qualifying charitable organization. If the funds ever land in your bank account first, even for a single day, you cannot call it a qualified charitable distribution on that year's return. The distribution becomes taxable, and your subsequent gift to the charity is only deductible if you itemize. The sequence matters absolutely. The second mistake is assuming any nonprofit qualifies. Qualified charitable distributions can only be made to organizations that are classified as public charities under Section 501(c)(3) of the Internal Revenue Code. Donor-advised funds do not qualify. Private foundations do not qualify. Supporting organizations do not qualify. If you want to give through a donor-advised fund, you cannot use a QCD to fund it. The gift must go directly to a public charity such as a church, a hospital, a university, a food bank, or a similar organization that holds public charity status. If you are unsure whether an organization qualifies, ask your IRA custodian or check the IRS tax exempt organization search tool at apps.irs.gov. The third mistake is waiting until the last week of December to set up the transfer for the first time. Most major custodians can process QCDs fairly quickly, but if you are directing a check to a charity and it needs to arrive by December 31st, you need time for the custodian to issue the check and for it to arrive and be processed by the charity. Give yourself at least 3 to 4 weeks before year end the first time you do this. The fourth mistake is not telling your tax preparer about the QCD after it happens. Even if your custodian codes the 1099 or correctly, which does not always happen, your preparer needs to know the amount of the QCD so they can write the correct taxable amount on line 4B and note the QCD exclusion on the return. Keep a record of every QCD you make during the year, the date, the amount, the name of the receiving charity, and confirmation of the transfer. Give that information to your preparer at tax time. Do not assume that 1099 tells the whole story, because often it does not. The fifth mistake is forgetting that you must be 70.5 years old at the time of the distribution, not just at the end of the tax year. The IRS is specific about this. If you turn 70 in March and your half birthday is in September, a QCD you make in July would not qualify because you were not yet 70.5 at the time of the distribution. A QCD you make in October would qualify because you had already reached 70.5. If you are approaching this age threshold, check your exact birthday and calculate your half birthday before initiating any transfers. The sixth mistake is not coordinating the QCD with your overall RMD strategy for the year. If you have multiple IRA accounts, your RMD is calculated on the total of all traditional IRA balances, but it can be satisfied by distributions from any one or combination of those accounts. The QCD can come from any of your traditional IRAs, but it can only come from a traditional IRA, a simple IRA if you have met the 2-year participation requirement, or a SEP IRA that is no longer actively receiving employer contributions. It cannot come from a 401k or 403b directly. You would need to roll the funds to a traditional IRA first. Now let me give you the action plan, because information without a clear next step is just entertainment. Here is what you need to do. If you are 70.5 or older and you have a traditional IRA and you give to qualified charities, this applies to you. Step 1 is to confirm that the charities you give to qualify as public charities under Section 501(c)(3). Your church almost certainly qualifies. Your local hospital foundation almost certainly qualifies. Your university scholarship fund almost certainly qualifies. If you give to a donor-advised fund, a private foundation, or a political organization, those do not qualify for QCDs. Identify the specific qualified charities you intend to support and confirm their eligibility. Step 2 is to contact your IRA custodian, whether that is Fidelity, Vanguard, Schwab, TIAA, or any other institution, and ask them specifically how they process qualified charitable distributions. Most major custodians have a dedicated form or online process for this. Ask whether they can make the check out directly to the charity or wire the funds, and ask about their typical processing time so you can plan for the year-end deadline. Step 3 is to determine the amount you want to direct as a QCD this year. It can be as small as a few $100s or as large as $108,000 in 2025. If you are trying to satisfy part of your required minimum distribution while reducing your taxable income, calculate how much of your RMD you actually need for living expenses and direct the remainder to charity through the QCD mechanism. Step 4 is to initiate the transfer before December 31st, not April 15th. December 31st is the hard deadline for QCDs to count toward the current tax year's RMD and to be excluded from that year's taxable income. If you are reading this after October, do not wait any longer. Initiate the process now. Step 5 is to document everything and communicate with your tax preparer. Write down the date, the amount, the custodian account it came from, and the charity it went to. When you receive your 1099 or in January, compare the gross distribution shown on the form with the total distributions you took during the year. Note separately which portion was a QCD. Bring this information to your preparer and specifically tell them you made qualified charitable distributions from your IRA. Ask them to show you where the exclusion appears on line 4B of your Form 1040. If they look at you blankly when you say the words qualified charitable distribution, you may need to find a preparer who is more familiar with retirement tax planning. There is one more dimension to this that I want to address before I close, and it is the interaction between the qualified charitable distribution and the senior bonus deduction that became available for tax years 2025 through 2028 under the One Big Beautiful Bill Act. The senior bonus deduction allows taxpayers who are 65 and older to claim an additional $6,000 deduction if they are single, or $12,000 if they are married and both spouses are 65 or older, as long as their modified adjusted gross income is below $75,000 for single filers or $150,000 for married couples. The QCD reduces your adjusted gross income by excluding IRA distributions from your taxable income. That lower AGI may help you remain below the income threshold for the senior bonus deduction, which phases out gradually above those limits. So in certain income situations, using a QCD to keep your AGI below the phase-out threshold for the senior bonus deduction stacks the two benefits on top of each other. You get the excluded IRA income from the QCD, and you keep your full eligibility for the $6,000 or $12,000 senior bonus deduction. Whether this stacking applies to your specific situation depends on your exact income numbers and the size of your required minimum distributions. But it is a planning opportunity that retirees who are near those phase-out thresholds should absolutely be evaluated with their tax professional. Let me come back to Dorothy for a moment because I want to give you the version of her story where she knows what she is doing. Dorothy is 73 years old, retiring principal in Tucson. She called her IRA custodian in October. She asks how to set up a qualified charitable distribution. She directs $3,000 to her church's building fund and $1,000 to the local food pantry she has supported for years, all directly from her IRA. Her 1099 are at year end shows a total distribution of $19,000. She tells her preparer that $4,000 of that was a qualified charitable distribution. Her preparer reports $19,000 on line 4A, $15,000 on line 4B, notes QCD on the dotted line, and Dorothy's taxable income is $4,000 lower than it would have been otherwise. The church gets the same $3,000 it always gets. The food pantry gets the same $1,000. Dorothy pays less in taxes. Her Social Security taxation is slightly reduced. She keeps more of what she earned over 34 years of shaping young people's lives. And the IRS gets exactly what it is owed and not $1 more. That is the system working as it was designed. Dorothy is not doing anything clever or aggressive or borderline. She is using a provision that Congress created specifically for her situation. The only thing that changed is that she knew to ask. The reason I make these videos is that the gap between retirees who keep more of their money and retirees who send extra to the IRS every April is almost never wealth. It is almost never complex. It is almost always information. A retiree with a $300,000 IRA who gives $5,000 to her church every year and does not know about QCDs will overpay her taxes every year for the rest of her life. A retiree with the same account, the same giving, and the same income who knows about QCDs and uses them correctly will save tens of thousands of dollars over the course of her retirement. The accounts are identical. The generosity is identical. The only difference is the checklist. And that is exactly why this channel exists. Before you file your next return, before you take your next required minimum distribution, before you write another check to any charity from your personal bank account, ask your IRA custodian one question. How do I set up a qualified charitable distribution? That one question, asked at the right time, is worth more than almost any other tax conversation you will have this year. This is Kevin's retirement strategy. If this video showed you something your preparer has never explained, hit the like button right now and share this with every retiree you know who gives to charity and has a traditional IRA. Tell me in the comments, did you already know about the QCD? And if so, how long have you been using it? I read every single one, and the most common situations become future videos. This is Kevin Retirement Strategy.